My name is Jan Davids. I'm the head of operations at Business Angels Europe. And today, basically, I want to moderate the session with Anne Le Breton Wolf. And she's perfectly suited for a session on access to finance. Why? Because she has such a broad experience in both the very early stage in angel investing to the later stage with VC and larger funds. And today, what we're really going to talk about is what we have called the A to Z of funding. But I think very basically, it's an overview of the differences between bank funding, angel investing, and venture capital. And these things are so important to distinguish, and all of them are important when you want to build your company and raise finance. So with that said, I want to give the floor to Anne. Thank you so much for coming here at short notice. And I will be sharing the screens now, Anne. Can you confirm?
Yes. So hello, everyone. Thank you, Jan, for such a kind introduction. And let's move on.
Let's go. So can you see my screen, Anne?
Not yet. It's still a dark gray screen.
What about now?
Yes, it's better this way.
Fantastic. So let me know when you want to have the next slide.
Yeah, okay. So let's go on just for a 30-minute session. You will have some time to ask Q&A after each section of this presentation, and at the very end if you have additional questions to ask me. So please, let's go to the introduction. Yes, so it's about myself. So I'm a French-based business angel. I have been involved in early stage financing since 2012. I hold an engineer diploma and an international finance master, and I have a professional experience in asset management. So I'm a little bit of a special angel. I am a woman. You will see the numbers, which makes me a little bit of a special animal in this world. But besides, I have not founded a startup yet. I have invested some of my savings in early stage projects and venture capital funds, and that's why I'm sitting here today to talk to you about funding. So for me, it's a matter of we will see it later on, but just getting into and helping entrepreneurs to grow their projects. So I have, for the time being, 9 active investments running. Some have been done this year, last year. I have not stopped during COVID time, yet I have seen less and screened less proposals during this period, but I have helped the investments I'm already in, and I had still a look at some new ones. And I have experienced 3 exits up to now. So one with a VC, one with an American corporation, and one with a French corporate. So I'm also jury member for EIT Digital and EIC Accelerator, which is best known as former SME instrument from the European Commission. And I am also jury member in numerous startup contests in France mainly, but also internationally. So maybe we can go on. Yes. So regarding today's A to Z funding presentation, just a quick introduction. So about what you need, and I think from the briefing I have had, is that most of you are entrepreneurs and are starting a business or are running a business that is just at its early days. So at the very start of the company, nothing new for you. You need a founding team, very motivated because hurdles are numerous. You need a well thought through idea, whether a product or a service, doesn't matter, but you have to think about it. And you have a company structure to build with initial capital, which generally speaking is brought in by founders' money. So when you set up a company, in some countries, like in France, you can set it up with €1 minimum, but in real life, if you have to run the very first days of your company, you will need a little bit more about €1,000 at minimum. So with those three elements, which are very, very important and are the pillars on which you will build your company, to make it grow afterwards, well, you need more. You need customers, suppliers, prescribers, okay, to do your day-to-day business. You may need IP and patents. It is not the case in every sector, meaning that coding cannot be patented up to now. So in some contexts, intellectual property will be a little bit tricky, but you will need it anyway. You need a workforce, whether your own person and motivation or hire someone else or some other people. You will need advice, consulting and networking, and you will need, of course, more money. So this presentation will be about the more money you will need. It can come from friends and family, which is what is generally done in the beginning, but also you will have to involve business angels, banks, venture capitalists, and other people. So let's dive a little bit more into that. So here I show you a self-made screening timeline. So it's just to set up the main steps of a company's growth in its early years. Of course, it is not the case and it is not a grid you should keep in mind and you have to fill all the boxes. No, it's not this way. It's just a general panorama of what I've seen in the business. But of course, each of you can go longer or shorter or just skip one or more of these steps, depending on your business, depending on the development of your business, on the growth, on the international context, etc. So first, on the left-hand side of the slide, you have inception with founders' money, as mentioned. And usually when you seed a company, when you launch a company, you put in thousands of equity. So it can be much more, of course. Do not overcapitalize your company at the very beginning, but you might need for regulatory issues or other reasons, you may need more than 10 or 20,000 euro initial capital. You might need to put more or less, depending on your business. Afterwards, you will just see that it works, that your POC or your MVP can go to somewhere interesting. And then you will usually raise money from your friends and families and potential some very early stage business angels and crowdfunding platforms. It is not mandatory to go and to contact all those people, but very early stage money will generally come from one or more of these. It's because you will need in tens of thousands up to 200,000 euro, generally speaking, to bridge this gap and to go to the next step. The next step being that your MVP has been tested, you have some early clients, early adopters, and you want to scale up, to grow a little bit more. And then, generally speaking, you will apply for grants, prizes. So grants, prizes can be local, can be national, can be international. It will just depend on what is suitable for your business and for you. It will also, and we will go later on about this, is about how much time it will consume you to apply for these grants and prizes. Yet, at this very early stage phase, it might be of interest because of the money, but also because of notoriety and a bit of advertisement and marketing that it will bring you. Because when you win a prize, it's always a way to put your company at the front stage, at the front row, and to have more attraction for your product or your idea, or that your brand is a little bit better known by the public. Then you will also go to see your bank and ask for a loan. So we will see the conditions, some of the conditions at least, and that's where you begin to open your balance sheet. We will see it in the conclusion, but onboarding a bank means that you have a third party that is entering your company. It is entering your company under special circumstances. You do not have to share equity with them, but you have to reimburse the loan that has been granted to you. So there you begin to have commitments to someone else. Then you go, generally speaking, to the pre-seed or seed phase with business angels and crowdfunding, possibly. Of course, you can choose, you can mix, you can have none of them. It's up to you, up to your needs and to your pragmatic needs to finance your company at an appropriate pace. Then you apply, generally speaking, for more grants, more prizes, more bank loans. To reach Series A, where you can close a deal with VCs and some VAs. And then you go for more if everything has been successful so far and if the growth trend is positive. And then you go for more bank loans, Series B, C's, IPO, etc. And then your bank will also syndicate some debt with other banks to bring you some mezzanine and hybrid debt, but that's further on down the road, or up the road at least, if everything has been successful so far. So just to focus on the first steps, it's a mixture of equity and debt financing. We will see it later on. And you have on this timeline and on this slide a bit of a summary of all the people or the third parties that will be involved in your gathering of money to help you grow the company. So can we please go? Yes. So I'm just having my watch close to me so that I do not take too much time. So bank funding, who are banks? Just a quick summary because I'm sure you all know about that, but banks are regulated financial institutions, mostly privately owned, but some are public. BPI in France, and there are some others in other places in the world, where public money can be granted in terms of debt, in terms of equities, in terms of honor or trust loans to young startups to help innovation grow in the country. So just look for that. Banks make profit on several business lines, but one of them, and the historical activity of the bank, is to lend money, is to collect money from people who want or who can save money, and to lend this money or part of this money, now with Basel II, Basel III regulation, but to lend part of this money to other people who need money to grow their project. That's the original business of the bank. And how does a bank make money? They make money on the difference. They serve a certain rate to the savings, and they lend the money to a higher rate to those who want to borrow money. That's the basic business of a bank. Well, it will apply to you as well. When you go to a bank to ask for a loan or a debt, they will lend you some money, but at a rate that is higher, of course, than the one you would get if you would bring that same money to the bank as a saving. But when doing that, they take on a risk. They take on the risk of not being reimbursed by the lender if your business goes south, or if you have some trouble, or if you are just not trustworthy. So they will need and they will require deposit, collateral, guarantee. It depends on the country and it depends on the type of loan that is granted. But anyhow, you will have to give some guarantee to the bank that you will reimburse them. It might be because you can reimburse them but you don't want to, or it may be that you cannot reimburse them. And in both cases, they would have given you the money first and not getting it back. So that's a problem, of course, for them running the bank. So they want some guarantee, and we will talk a little bit more about that. But just remember, the bank is there to lend you some money and to make money for themselves on the interest rates at which they lend you the money in exchange of the risk they are taking. Let's go on. Thank you. So, bank funding. Banks very seldom invest in equity in external early stage projects. You will note that I have put external early stage projects, as you might know about entrepreneurship, where some companies through their CVC fund, for instance, can take some equity in internally grown projects. But let's keep that and stay in the general case where the bank will not invest in your company in equity, but the interaction with the bank will be through debt and later on corporate treasury financing. So why inviting a bank on your balance sheet on the liability side, on the debt side, through a loan? Well, it's fairly quick available money to fund your project. It's the fixed cost and parameters, horizon of lending, terms and conditions, so you know what you are going for. And it's non-dilutive money, meaning that the bank has no voting rights, has no profit to share with you, and you don't have profit to share with them. But it's a fixed framework. They lend you money for a certain time at a certain interest rates with certain guarantees. Often banks limit the loan to 3 to 4 times founder's equity in the company, in the beginning at least. If you grow more, of course, they can lend you more than what you have put in equity in your company. But at the very beginning, the 4 times ratio is, generally speaking, the real maximum they will go to. So if you have put 20,000 euro in your company, they will possibly lend you up to 80,000 euro. But if you require 300,000, for instance, they will ask for more guarantee on your personal wealth, for instance. Also to mention, honor loans, which are also called sometimes trust loans. So they are based on trust, often with 0 interest rates, and they are to be considered as they can be obtained at some banking institutions, but also foundations or other people that are supporting the ecosystem. So for you, it would be of great interest if you have some honor loans. You have to reimburse them after a while, after 3 to 5 years, generally speaking, but the interest rate is 0, and often you don't have setup or initial fees. So that's really, it's not free money because you have to give it back, but it's still very interesting, and sometimes they are more willing to take on risk with less guarantee than what a bank would do. So just consider it if you are offered the proposal, or if you can go for honor loans. Of course, they're restricted in amount, but if you can get 50,000 or 100,000 in honor loans, that can be of great help. Right, the pros and cons of bank funding. Well, the pros, we have seen it, you know what you are going for. Fixed expenses. Generally speaking, the interest rate for a startup will be between 3% to 5% for a 5-year loan. Of course, it depends on the bank, on the amount, on the country, on your business, etc. But yes, I've seen the question. But of course, it depends. But let's take into account that around 4%, it should be somewhere you can get to. So that has to match with your business plan, and that's something I'm insisting on, because of course it's interesting. You might say, well, I get 50,000 as a bank loan immediately, but you remember that you will have to pay back 2,000 euro each year, and also you have to reimburse the whole money in the end, or you will have to reimburse part of this money each month or each year. So it has to match with your business plan, and it can be a real constraint if you have a slowly growing business, that you have taken on this constraint to reimburse the bank that has lent you money. You can go for renegotiation, but then it's a negotiation. The other counterparty has to agree. So just remember, it's quite easy money up to a certain amount, but it has to match your business plan, because otherwise we'll get into trouble. The bank really wants their money back. Also, one of the pros is about non-dilution. You do not have to share voting rights or profits or future profit with the bank. And that means that in terms of governance, your bank cannot decide, unless you are bankrupt, or your company goes really bankrupt or liquidated, and they have some money to get back, but they cannot decide on governance of your company. So you are still, with a bank loan, able to pilot your company. But the cons is that warranties and deposit might be required. Again, the bank wants their money back. And so if they have lent you money and that you have invested it in wages, in IP, in machines, etc., if you cannot reimburse the bank has to sell what is left of your company and they might not get their money back. So they want other assets as collateral. So it is sometimes your personal guarantee, but just be careful about that because it can really put you into trouble if your company has a problem. So be cautious about that and do not engage yourself too high if you think that the level of risk might endanger your personal life as well. And the bank also will be the first to be reimbursed in case of default. So meaning that if your company goes to liquidation, then you have to pay first the debt, and if there is something left, equity shareholder will share what is left, but the bank will be first to be served on what is left if things go wrong. Right, so I've seen a question in the chat also, honor or trust loans. I know about French foundation which is called RAISE, RAISE. There are also other partners like Réseau Entreprendre in France. They're based in the northern part of France, but they have entities everywhere in the country and maybe perhaps also in Belgium, but you have to check about that. So those are French names who are granting quite a lot of honor loans, and they are in other countries, but just check. Generally speaking, if you have trade ministry or some local instance that are helping innovation, they might be able to give you some names. Some institutions are public and grant honor loans, and some others are privately owned foundations or run foundations that can also grant you some loans. Alumni also from your business school or engineering school or your university might also have some power for granting honor loans. It depends on the country and on the type of structure.
Dear Anne, I just want to break in here. I want to be mindful of time. We're already going good, but I would suggest maybe to skip the next slide at least and move forward a bit quicker.
Okay.
If that's okay.
Right. So let's go to the next slide. So other funding sources, I have mentioned honor loans, grants and prizes, local, national, European. I've mentioned some names. I have put you a www website, which is EU calls, and you will see numerous calls from the European Commission where they support innovation. You can apply, and some of them, if you are a winner or part of the winners, you will get some money, some equity, you will get some loans, you will get some prizes in terms of coaching or media exposure, etc. So just check about that. The pros of grants and prizes is that it's non-dilutive cash and you have a bonus in terms of image and marketing. The cons are time for application. It sometimes takes startups quite a lot of time to go through and to set up a 10 or 20 page document to apply. But just be selective and go for the ones that can really be of interest to you. The most well-known is EIC Accelerator, former SME Instruments, and it's also where the grants and the equity investments from the European Commission are the higher. Regarding also, as I know there are some women listening to this video conference, there is a prize running up to November 10th by the European Commission for women who are involved in tech startups, who are leading or co-leading tech startups. So if you're interested, just go for that and have a look. Also, other funding sources is crowdfunding through debt and or equity. You have numerous crowdfunding platforms. The pros of applying to that is that it's especially suited for B2C business models. or project with impact. And by applying for crowdfunding money, you also can build a community and do some marketing to your first adopters and to build a community around your product or your project. So crowdfunding is money, but it's in a way smart money, or at least marketing money you get as well. The cons are the high debt costs. Usually it's much more expensive than a bank, and the limited amounts that you can get. Usually crowdfunding campaign, apart from for some countries where real estate crowdfunding is very developed at the time being, but generally speaking, if you go for a crowdfunding equity or debt campaign, it's usually in hundreds of thousands of euros and seldom more than 500,000 euros. It can be, but in early stage, it's seldom more. Right, so now let's go to business angels, who will also be one of the money funding partners that you can reach. So business angels are men and women who devote part of their time, knowledge, network, and money, are concerned with entrepreneurship and innovation, and believe in free market and capitalism. Remember that a business angel is a person. Generally, it's someone that cares about company life, about entrepreneurship, but we are doing it for money. It's not philanthropy, it's not a gift, it says an investment. It's smart and kind money, hopefully, but it's still an investment. So as a bank, we want our money back, or at least we grant you trust for you to grow and that we share profit with you. So what do we do this for? We do this to invest in equities, sometimes convertible debt, for young fast-growing startups, and also, of course, to support founders' teams over the years. We usually do that in sectors that we are comfortable with, that we have worked in, or on which we have some kind of knowledge or network that is operating, also to be helpful to the entrepreneur and to be able to lead the due diligence. Right, the profile. So as mentioned, most men. In Europe, around 90% of business angels are men. It's the same in North America. So business angel used to be late career retired people that were lawyers, engineers, consultants. But now there's a younger generation that is stepping in, a middle-aged generation like myself of executives from companies that want to devote part of their time and part of their money to the ecosystem. And also the younger generation than myself of tech founders that are reinvesting in the ecosystem some of the proceeds they have received when selling part or the whole bunch of their startups. So we don't have figures, and that's why I put a question mark on the real percentage of each tranche of business angel, but you will surely meet all of those on your track to growth. So BA investing is a free time side activity. It's seldom a full-time job. Usually you devote 1 hour per month per investment to your startup. Of course, in some cases, the business angel will be more present. In some others, it will be more distant and more cyclical over time. Sometimes devote more time and sometimes be less present. But usually that's what it takes to business angel to follow up a company. And then usually, just to give you a flavor, we devote 5 to 10% of net wealth to this activity, but it's still a side activity. It's not, of course, the main investment someone will do. And as mentioned, in sectors that we are familiar with technical knowledge and network. Right.
If I may end, just to break in again, 15 minutes left, so much to discuss. Maybe we could already skip the next 2 slides. What do you think?
Let's go.
Because we know who the angels are. Of course, they work together, they co-invest. But with venture capital to go and 15 minutes left, I would suggest to go here. Yeah.
There. So pros and cons. It's smart money. It's patient money. Why patient? Because we do not have a time horizon that is defined. Whereas at the opposite, the bank wants their money back at a given time, and VCs, like we will see later on, will want also a time horizon that is given and that is a little bit flexible but not much. Whereas for business angels, we do not have a fixed time horizon. That's something very interesting for entrepreneurs. It's also slow money because we are not as quick as the bank and often not as quick as VCs to make the decision to invest. Sometimes you have, especially if business angels are operating as a network, you have to convince some of them to pass through due diligence gates, etc. So it may take quite a lot of time to get some investment from business angels. Of course, it depends. Some are very reactive, but generally a minimum of 3 to 4 months to go through all the steps or the steps to onboard a network of business angels or a bunch of individual business angels has to be taken into account. And also, for some, it's a real luck and a real chance to have business angels on board. For some others, they consider it as a real pain, as business angels are individuals that may require to have some information about the company, so it may be even intrusive. But generally speaking, the trend is more to onboard business angels and to value also what they can bring in terms of smart money with their network, their acquaintances, their knowledge of the sector, and also this notion of patience, especially in COVID time. Right, let's move on to VC funding. VC funding is equity funding. I'll quickly go through the slide, but just to let you know that VCs are operating as privately owned companies with profit objective. So they make money on investing in the right company and selling the shares later on, 5, 7, 10 years later, with a profit. That's the business model of a VC. Right, why inviting VCs on your cap table? Well, they have money to invest in strong growing business, so some sectors might be of less interest for them, and they might look more for less capital intensive sectors that can experience exit quickly or quicker. They have a predefined time horizon from 3 to 7 years, but they have to give back the money to their LPs after 10 or for some 12 years, so they do not have extensive time horizon for investment. Some sectors are less favored, as mentioned, and you have to find the right match. The right match in terms of investment policy of the VC, and also in terms of relationship you will have with them. And so you have to filter the ecosystem, to screen, to find the ones that could be interested and that could have a good match with you. Just one thing about that, just look for what others in your sectors and with the same size than you have done, who they have contacted and who has invested in their capital. And you will have quite a long list of VCs, and just screen them through and see whether it would be appropriate for you to contact them for capital funding. So the pros and cons of onboarding VCs, well, they are equity stakeholders, so they will enter your company with a right to vote and a right to say. So be careful of who you onboard in your capital, meaning that it's like on a boat or on an airplane. You let those people in, but you have to stay with them for quite a long time. So just do your best to select the people you want to bring in your adventure and in your startup, as they will be involved in governance and they will have a right to say. They will also have a right to share profit with you, depending of course on the percentage of capital they are holding. Equity stakeholders cannot be forced to exit except in very severe cases, so they might stay on for some time and you cannot just reimburse them to let them out. And equity stakeholders are therefore better or worse, and might also as the bank will ask for some guarantees, ask for some preferred covenants, which means that they might ask for to be served first, at least partly, if there are profits or if there are gains that are made on selling the company partially or totally. So they might also not only sit on your equity table or your cap table, which is quite logical, but they might also want to have a little more, some preferred revenues or some preferred gain profit sharing if the company gets sold. Right, so what does it look like on a balance sheet to have all those funding partners with you? On the left side, grants and prices will go in your cash, so it will be free money coming in. On the equity side, well, it will be VCs and business angels stepping in during fundraising campaign, where you issue, generally speaking, new shares that will be brought to those people for money to come into the company, and so it will inflate your equity part. And debt also, honor loans, which is quite convenient debt, but which will sit on your balance sheet in the debt section, and also bank loans, which will also inflate your debt bucket of your company. So as a conclusion, to leave you 5 minutes for some Q&A if you have some, it's important to consider how much funding you really need, which investor profile you are ready to onboard, and where money can be available for you. It's those 3 tips I would give you. It's really important to calibrate properly the needs of your 18 to 24 months ahead. Do not be too greedy. You won't get what you are asking for, and you will lose credibility. But do not target too low, because if you have to spend sometimes and quite a lot of time to raise money, whether to go to see banks, business angels, VCs, etc. So just calibrate it properly so that you do not lose too much time going to see some funding partners, but that you get the money you need to run your business at least for 1.5 years or 2 years. Also, bootstrapping can be an alternative, but it's only adequate for some business, and it can slow down your scale-up process. Bootstrapping is that you only finance the company by yourself, by your own savings, and by the profits that are made by your company. It can be done in some service areas, but it will be hard unless you are very wealthy to support growth and to grow at a reasonable pace that makes you still have the leadership on your market and not be swallowed up by your competitors. And also, by the time most startups reach Series A, growth has been financed, generally speaking, by a mixture of grants, business angels, banks, and VCs money. Meaning that the startups I have invested in, I think nearly all, if not all, have a mixture of all those funding partners on their balance sheet and have gone to see them at different stages of their development and with different funding needs. So with this, I'll open up to questions.
Thank you, Anne. We made it in the end and even on time, so we have 5 minutes left. I would really enthuse everyone who's still here with us to fire your questions at Anne. She's extremely experienced in the startup world, and so I'm sure she will be very happy to answer your questions. While we are waiting, maybe a question for myself first, because I work in the angel investment industry now for half a decade. And so the only things I'm reading about are almost equity and venture capital, etc., etc. And just maybe a question from my side, do you feel as though entrepreneurs are too focused on equity nowadays and that they should maybe rediscover the value of going to a bank and going for a bank loan? What do you see in the market?
Yes, well, interest rates are quite still low at the moment, so depending on what your inflation expectations and central bank policy might be, it might be interesting to go for a loan for the time being. a lot of them are quite cautious about all the guarantees that the bank might ask for to give you some loan. But I think in terms of cost of capital, generally speaking, to grow your business, a bank loan and not only going to equity might be of interest because it's non-dilutive. Because if in the early steps and in the young age of your company, you give up too much equity to investors or to partners, to accelerators, incubators, etc., then when you really need to grow and when your company is worth a little bit more, then you might be close to losing the majority in a seed round or Series A. And then it's a bit of a shame because you also lose some kind of power, some kind of equity profit and sharing profit of what's the work and the risk you have taken. So I would go for a mixture of debt and equity and do not rush too far to give up equity in the early days, because otherwise it will be a problem if things go well, of course, at Series A level.
Thank you, Anne. That's great, and that you turned this answer as well into the cap table, because you really zoned in on this point. And I think is really crucial for everybody to realize that indeed, if you give too much equity away for some good money in the first stages, you will lose out in the end because there's not enough left. I have a question from Grace Smith. Grace Smith, she's asking, any general tips for finding and approaching angel investors?
Well, you can ask Jan. He surely knows quite a lot of us. Yeah. And also, there are some angels networks at the European level. So Jan will be the appropriate person to talk to. There are some at national level. So you can go on the internet, just Google business angel in your country, and then you will see. You can also go on LinkedIn. There are some that are really talkative and write a lot of comments and posts on their activity. And also, generally speaking, there are fairs. So maybe Vivatech or some other fairs that are taking place in Geneva, Berlin, for instance, and London and other places in Europe, where you can meet. Often it's about innovation fairs and conferences, and there you will meet some business angels.
But let me break in here, because just a step back, right? A lot of angel investors are part of networks. And the networks supply the deal flow, so the startups, to them. And in that way, they can remain anonymous as well. What I even see, while I'm not even close to becoming an angel investor, I still see a lot of people coming to my LinkedIn and asking for a contact directly. While I think it's important to note that most angel investors don't like to operate as much in the open. Just a quick question to you. How do you like to be approached yourself? Do you go through networks or?
So for myself, it's a bit of both. I have been member of a network, of a French business angel network up to recently. Because of COVID and personal issues, I have not been member last year, but anyhow, I'm also member of another business angel network. So I operate in a network. I'm also close to other club deals that are structured. And also I operate individually through the alumni network of my former schools. And also I go to Vivatech and some other places where I can meet directly with startups. And then if the match is correct, I can go. So just to answer Jan's question more explicitly, also via LinkedIn, I usually answer if someone gets into contact with me and writes an introduction message which sounds relevant.
Fantastic. Thank you, Anne. We already have to leave it at this. 45 minutes, that's all we received. I want to thank you though for spreading your wisdom and lesson learned on these different types of finance. And I will share the slides with all the participants, and they can be in touch with you, as you said, maybe via LinkedIn.
Yeah, thank you very much.